Welcome to the market update of February 2023, Belva Capital. Thanks for joining. So when we look back end of January, what did we expect? We've seen in the US, the equity markets just approaching the 200 moving average. And this was a very exciting moment. And we broke through that. And we've seen really uprising markets for another 2 weeks until mid of February. And this was just the inflection point when new inflation numbers came out in the US. And we've seen that they are still high and higher than expected, as well as the labor market. So what happened in the last 2 weeks, we just went back to exactly that 200 moving average line. In the next days, we will see if the markets will bounce back upwards or we go back into a bear market cycle. What happened in Europe? Europe is much stronger, and we've seen that for the third time in the last 30 years, that especially the European stock markets and the European indices were much stronger and much better over the last 3 to 6 months. Why is that, and how do we see it for the future? The European indices are much more defensive with financials, with industrial stocks and consumer staples, which were really performing well and outperformed the American market. And the dispersion is really huge already, in between 10 and 20%, depending on the index you look at. And how do we see that for the future? In America, we have a much higher interest rate right now. We are at 3.9% on the 10-year Treasury, as I mentioned before. And in Europe, we're around 2.5%. So this interest differential is benefiting especially for European markets. But when we look into Europe, we've also seen that the dispersion in between the peripheral countries like Italy, Spain, Portugal, Greece, and for example, France and Germany, that the dispersion between the German treasuries, the 10-year treasuries, are yielding now 2.5% versus 2.6% versus Italy already at 4.5%. So we have to watch really carefully what the ECB is going to do in the next meeting, and with the strategy over the next month, how to avoid this widening of the spreads. Because on the long run, Italy and the peripheral countries cannot really burden those interest rates. So it will be very, very interesting. On the stock market, we expect quality is key again. Why? Because with high interest rates, only those companies with strong balance sheets, with a strong business model, and also a power to pass on the inflation to the customers and to the consumers will benefit from higher inflation rates. So it's very key to stay invested in quality, and tech, which is not making money, which doesn't have the power to really spill over that inflation, you should really watch carefully what you invest with. And we are excited about that 200 moving average, if it's going to hold in March or not. And we will stay tuned in March. Thank you very much.